It's the Market Sniper. Can I request you hit the like button immediately and give us a share? That's greatly appreciated. We aim to bring you major breaking trades at key events. Okay, so what are we talking about today? The US dollar versus the Hong Kong dollar. And in this particular outtake, this is the monthly chart that I've done an edit for. This is in and around the era of Faulkner tightening on interest rates over here, around about the late 70s into 81. See it there in the blue line. I'll actually change color so it stands out better. That was a dollar hiking period, a very strong dollar hiking period. What was it to do? To kill inflation. Sounds familiar and kind of interesting. Anyway, during that period, you would have found that in and around the levels of 4.5, 4.6, 4.7 to the Hong Kong dollar, you ended up running up to 7.8, where we find ourselves between the two blue lines, the dashed blue lines, a current trading range. That's an unofficial peg that has both a low and a high. Were we to have a similar breakout to the upside on a similar event where it is seen to be that the Americans continue to tighten interest rates in the name of inflation, sounds familiar, you could indeed find a similar percentage move could be geometrically possible, and as a result you may find yourself in and around the 13s. This is actually a conservative number, 13. This is taken from the mid of the range, and the percentage take is taken up to the lower end of the band. This is not the maximum potential, but were you to get a similar percentage move of loss of value in the Hong Kong dollar, in fact the Hong Kong dollar could disappear entirely, but that's a story for another day. So what's happening in Hong Kong? Well, a couple of fundamental facts. 10% of the usual revenue they do in H1 has been earned this year. So the first half of the year, they've done 1/10 of the IPO listings revenue in their nation state that they typically do in previous years. So what does that mean? It means people are very nervous about Hong Kong right now. That's what it means. And as a result, the notion of this capitalist island in the far Asia is clearly under attack, with all things China and other matters that are associated with their geopolitical lack of stability. So when you start losing revenue, remember IPOs, Hong Kong is kind of like the City of London or New York. Financial services are the big thing. So financial services are the big thing over there. You start losing interest as a financial hub because you're compromised, and more of that business goes to, say, Singapore or other Eastern Sydney. You lose a lot of your revenue. So with that revenue being lost, this is of great concern to Hong Kong. Our opinion in this video, and one of the hardest, stupidest almost, and most difficult things to do, is to try pick the point at which a peg fails. Our overall view is that that's a very difficult thing to do. However, we are here to say, despite the difficulty of that, the extreme difficulty, it's threading a needle in a haystack, is that there is an appreciation for the heightened degree of probability for a substantial revaluation in the USD Hong Kong dollar exchange rate in the short to near term. We have this Friday, we will have non-farm payrolls. In the weeks that follow and the months that follow, it's our opinion that you're going to see a major decay in the Hong Kong 33, often known as the Hang Seng, to the downside, and I'm going to be showing you why. Downside on the Hong Kong Hang Seng 33 or 40, as it sometimes has been, is extremely bearish for the Hong Kong dollar and causes great duress. Further to which, I want to highlight that China and Chinese people are actively engaged, obviously, in Hong Kong to a high degree, and China has probably never been more precariously situated in terms of its debt position, following the Shanghai Accord of 2016, more on that in a bit, and also its housing market, where people are abstaining on paying mortgages on developments that have ceased to move forward, where developers have potentially been marginally bankrupt. In other words, there's a culture of non-payment. There have also been, in 86 different banks and locations, restrictions on how much cash could be withdrawn, and there's actually been refusals to allow access to cash in China. So there is a real emergency that is going on. There's real crisis that is going on in China. And when I talk of China, remember, many of the wealthy in China have assets in Hong Kong. Many of Hong Kong may have exposure to China. So this is a very, very central thing, and you're not getting full disclosure or a lot of media coverage. You have to go to the alternative media to see what has been going on. So there you have 13.1 as a potential long-run target. I wouldn't go there in a straight line, but a break, first of all, of the range that has been established at the peak ceiling range at 7.85 would be potentially a beginning of a journey to a loss of value that could take you to 13.1. If you want the more aggressive draw, what could it be at its absolute worst case if it were to make an extreme target? And if I took it a bit more aggressively, we will see now. Let's draw, and I'll bring up another for you. So were you to take it right to the peak high over here of that particular extremity and take the percentage from the lower end or at the higher end of the range for that full, you could even see 14.89. Now, given that you get extremities, you might technically run the 15. That's a very aggressive targeting. It's obviously targeted to its highest point over here from one of the lowest down there. So, you've had a full move of a similar scale. You could argue that with the debt situation, it's quite feasible that you could overperform on that. But we don't always want to be excessively aggressive, and that's also from the high end of the range instead of from the midpoint in the range. So you have two numbers, somewhere between 13 and possibly 15 in terms of potential eventual erosion. I would also argue in reset times that you could indeed, in fact, have a complete end to the Hong Kong dollar as a currency, and it gets assumed by China were it to be deemed unsustainable in its current mean. And it's always, I think, the long run goal, in much the same way as China eyes Taiwan, which has also had the rather interesting narrative of where is Nancy Pelosi? Is she going? Is she not going? This who shot JR? Is she? Won't she? Will she? And all of the shenanigans for which she might be in somewhere in the area. It seems like they want to distract you with a potential conflict of some sorts whereby these events might take place. I want to highlight again, no one else is talking about this. It is our expectation and potential view that in fact you are at an outlier level of higher probability. Now, the probability of a peg fail that is in existence for 40 years is extremely low. So we are not saying it's gone to an absolute certainty to be in the near term, but it is significantly higher than it has typically been for a peg fail, USD, Hong Kong dollar. So let's look at this chart that we have here. This is the Hong Kong 33. And I want to highlight the adverse relationship, or the inverse and adverse relationship between the equity markets in Hong Kong and the overall peg movements, even though the peg is within a band. So that's your low 7.75 and your high is in and around 7.85. So pretty tight range. It did actually slip a little bit higher to 7.75 to 85. It was a tiny bit lower. So we're now focusing on those two blue lines on the bottom half of the chart. That is your US dollar, Hong Kong dollar. Now, as you can see, most of the time you were well below that. In fact, there was clearly central bank engagement at this level, keeping it very tightly at that level. When you get spinning tops along that level, it's quite clear. You can see also quite a crop top over there. So it was clear that they were actually intervening earlier at around the 7.8 level, and that's been allowed to slip to the 7.85 more recently. When was that more recently? We'll cover that in a short bit, but before I do that, let me just illustrate a major sell-off. This was during the great financial crisis from up top here on the Hong Kong. It must have been around, well, I'd love to tell you. Let's get a cursor to tell you what the highs here. This was literally one of the highest localized highs in and around 32,000 on the Hang Seng, with a big sell all the way down, right the way down to 10,000. That was awful. And what you actually saw also is that there was some pressure on the peg. When that market came down, the USD Hong Kong, the weakening of the Hong Kong dollar also occurred with the weakening of their stock market. Again, when we had the sell-offs in and around 2011 into the mid to late 2011 lows, you also had a weakening in the peg. The blue lines, the red lines, the arrows. Here again, when we went into what was probably the Shanghai Accord, real weakening and real stress, this is when the unofficial name, the Shanghai Accord, was when China now was suddenly hopelessly indebted, having built all these cities, created heat during the period of the great financial crisis. Everybody was talking about China being bigger than America. The debt then fizzled out or came unmanageable, and they were in deep, deep trouble during that period. And then the world gathered together, the G8, the G20, and suddenly a little bit of a solution. So that was a pivotal moment, and I'll be highlighting that around about the 2016, going into 2016. Again, you could see that pressure in the Hong Kong dollar associated with the sell-off on the Hong Kong 33. Here again, when we got to highs of 2018, you can see a selling off, and again pushed to a new high on the peg where they let it slip to 7.85. Then, during this period, the only reason that the Hong Kong dollar peg went to the low end of the range, I want to remind you, is during that period, and let's have a look at this annotation charts that I prepared for you with regards to that. On the macro here. So this is a screenshot of that. And this, by the way, is something I was doing for my premium community. So you can join us by going to themarketsniper.com. We look to make reset wealth during reset time and protect your wealth as well as what you make during reset season. So we are specifically focused with the macroeconomics that is associated with the planned reset that is coming. And if that sounds and resonates with you, click the link, book a call, talk to someone just like you a couple of years ahead who's been a member of our community for an extended period, and ask him if he's glad he made that investment, and also get a show of all that we do, from our learning materials, our resources, our partners that we help you get set up to see through reset in the best possible way. Okay, back to this chart. So I've shown you the red and the orange lines. I'm showing you also the point of Shanghai Accord during the 2016 year starting, how we lost and set a new precedent, 7.85, so they let it leak a little higher. Then the dollar mega print, 6 to 7 trillion, who knows, sometimes I hear 4.5, we don't know, ungodly sum that prevailed the dollar to a huge degree and brought it to the bottom end of that range. That took a lot of relief, or gave a lot of relief to a lot of nation states that were really battling and short of dollars during that period, and weakened the dollar immensely. Then we got, and this was of course the events of March 2020, known as the pandemic. Then we were over here. Quickly you could see that those dollars were lopped up, and you started to see a brisk move to the upside. Associated again, shooting star, top, localized high on the Hang Seng. Since then, in a key sell-off, what do you get? Moving from one end of the range to the other. Now, in that orange box, you can see some annotations, and it's our express opinion that you are in further downside for the Hang Seng. Further downside for the Hang Seng, and that you are in an inverted HVF. Learn all about HVF method. Click on the link, book a call. So that is that particular chart. So what about that downside? How does it look? Well, let's also just show you a couple of things with the two charts superimposed. This is monthly charts you've been looking at. This is on the monthly. We're now going to show you those same charts and that inverted HVF on the Hang Seng, again on the top side here. Now ignore the red arrow, that is from the bigger monthly chart, and the blue one from the bigger monthly chart for now. And let's wipe the face a little bit. And what you can see is that we are having an inverted HVF squeeze. You can learn about HVF method, as I've already said, basing ascending grind line, and you've got a fractalized squeeze, which has now begun a break to the downside. Again, when we have a look at these smaller time frame charts, what we see and what we learn is, in actual fact, that you are going down when on the Hong Kong index, and you are going down on USD Hong Kong up to that top end of that range. You can see that down there is an up to the limit there. Down during this period into that high was an up to the top of the range on the USD Hong Kong. Again, slight move down over here, partial move, and again you can see tapping up. Throughout this period, you are in an ascending triangle. The Hong Kong government and its financial structures are actually buying Hong Kong dollars and selling US dollars. That means they are losing their Hong Kong reserves. Let's have a little news flash. So here you go, no less than Reuters. HKMA buys 6.4 billion from the market of Hong Kong dollars as currency hits weak end of trading band. Hong Kong's de facto central bank bought 816 million from the market in New York trading hours to stop the local currency weakening. This is what is called a peg, between 7.75 and 7.85. So the key gauge of cash in the banking system will decrease from 204.865 billion on July, said on yesterday, currently at 17.85, very close to 17.85. So this is the proof of the weakening in reserves position at a time that income is going down, at a time that China is turning down, at a time that China housing is turning down, at a time that China's banking is under question for solvency, liquidity, and ability to provide cash to its citizens, all occurring simultaneously. And at the same time, Resetenomics Punch and Judy show Pelosi is gaming and creating a narrative around herself. So let's go to the 10-hour. We're dropping harshly from the monthly right down to the 10-hour to capture what is happening in both these charts on a much smaller time frame. Why? Because it's my assessment that things are moving quicker than people realize, and that in months and maybe even weeks we could have an event. Don't forget, this Friday we also have the event that is known as non-farm payrolls, where data will come out. Possibly if the dollar starts to show greater strength, we could see interesting things. So let's just look at the upper side first. This is what we typically call a low one, a bounce, a low two, and then a real squeezing with a beautiful little primer. You'll learn about that and more. Basing ascending grind line broken, a fractal. You're at a rest point here where you may get a rally back up, but after that some of our biggest capitulation moves typically occur on the macro round here. So the Hong Kong dollar is a peg fail in our opinion, on account that this index, which is exceedingly weak, will be the canary in the gold mine for flight capital. This is the key point. They don't have to correlate, but the key point is if people are selling out of shares in the Hong Kong market for fear surrounding the Chinese market and other markets. I'm just going to take that and make it disappear for a second because it's a bit intrusive. If people are in fear, it's not showing me where it is. There it is. And what about you? There it is. Make it go away, make it go away. If people are in fear about the future prospects and are selling the equity market in a time like such, what ends up happening is there is a real concern around the equity. They sell the equities, and it is usually foreign direct investment and possibly Chinese. What will they do? They sell, they take it out of Hong Kong dollars and they put it in a currency of choice, which could be the yuan, or it could be more likely the US dollar, maybe Swiss francs. So wealthy Chinese businessmen that have interest in Hong Kong, wealthy local Hong Kong businessmen that have interest in Hong Kong will sell out of their local market and repatriate that funds somewhere else where they will have access to dollars or a different banking system. So they might move it into dollars in Singapore. If they are of Asian heritage, they might move it into an American bank in dollars. If they are Western, for example, or European, into francs, maybe in Switzerland. So this is typical behavior. So when you have flight capital, foreign direct investment that is in the place, and when you consider that Hong Kong is also essentially soon to become no more than a province of China, many Chinese people will also hedge their bets on the downside. It has a hypervalued property market. Its income is down by 90% on IPOs, and you are seeing an ascending, and this is where the technicals meet those fundamental arguments. You are seeing a downside HVF that we see will call for 16,000. You could have been short from the 20s up top here on this fractal in the mid area on this primer. 20, let's get you an actual value in and around there, the triggering of the break of our bagel, 20,600 to 16. Now you might not say that's a lot. It's over 4,000 roughly, or around 4,000 out of 20. That's about 20% descent. Now, as you've noticed before, these down legs is an indication of capital leaving. So the only way the peg stays where it currently is in this rather ascending structure, an ascending structure that is known also as a combination in our parlance of an ascending HVF, but to traditional technical people as an ascending triangle, where the volatility is super low. Volatility is super low when central banks are doing their damnedest to keep something down, but not trying to attract too much attention. So there's been nothing but distribution during these periods of dollars to support the Hong Kong dollar at these points. And as we move more recently, you can see there's been a sustained period at this third high here, protecting the Hong Kong dollar, and you are there again now. This is an HVF ascending structure. With data to come on Friday, if it's dollar supportive, this could put a lot of pressure on it. You could see a restating of the range. They could restate the range a little bit broader, a little bit higher up, and it would bleed up into there. But that would just fill up super fast and the market would move, and they will face the same problem. They could walk away from the peg for a while. It could blow really far. There's a number of things that could happen, but it's our opinion that people are underestimating the level at which this potential pair could face a key peg break. And I want to also highlight, everyone goes on about the dollar milkshake. The dollar milkshake has been around dollar dominance and Triffin's dilemma. But what we've been highlighting goes beyond just the dollar milkshake theory. We have been highlighting the real key Asian FX crisis that is coming. Dollar milkshake does not address an Asian FX crisis specifically. We have handled the USD Korean won with you. We have already given at 107 the biggest mover, which is the Japanese yen, right the way up to 138, now in a pullback state. Which has an unbelievable move. You're talking around about 30%, nearly 28% from 107s to 138 at its peak, now trading around 130. Massive pressure. So much devaluation in the yen, where there's yield curve control as well, gives a major export advantage to the reduced value yen at the expense of Hong Kong, Korea, and many others. We have continued to highlight that there is a serious risk of an Asian FX crisis. We've also spoken of the euro crisis separately. And it's not just about the dollar dominance, but it's about certain regions that need to re-rate. In our Korean won highlights real, which we have shared a couple of times and is now making moderate progress, but has not yet had its blow-off major event. We have regularly referred to the forthcoming 2022, maybe 2023 Asian crisis. Here is that charts with the annotations that we have given you right the way back up to the monthly point, and you can see this is one we've shared many times before. And you can see all the original events, including the original crisis for the Asian currencies, which was across the board, which was also very, very damning. The Hong Kong dollar survived that during that period. But the original Asian crisis was destructive to the Indonesian rupiah, the ringgit, and of course the Korean won over here. Huge move back in the 97, 98. Then in the great financial crisis, you had a secondary spike. Here was where the Shanghai Accord occurred, real weakness on the Chinese debt situation, and of course the Korean won weakened into that. Then we had the COVID-19 run-up before the 7 trillion print, which pulled it back down. And since then we have been in breakout, but making slow progress. And this is the Asian FX debt crisis, which comes with some dollar dominance, which is part overlaps with the milkshake theory. Asian FX debt crisis of 2022-3 3. The fact that you may also have a euro crisis in that may well also overlap. But do not take your eye off the fact that there will be a major rating in the Western-friendly Asian nations of Hong Kong, Korea, many others I haven't mentioned that are less easily tradable, and of course already seen begin on the USD/JPY. However, to touch on the USD/JPY, you can see that there has been some degree of pullback so far, but in a percentage terms, this has been a highly substantial move right the way up to its ultimate high in and around the 139s. So corrective element is certainly feasible, but you've had such volatility and such impulsive action in favor of the dollar, it's only to be expected. So in the period of roundabout from the 11, you've gone from 76 to over 130. And at its peak almost represented halvening of the Japanese buying power against a currency that is losing buying power against the likes of gold and silver and many other commodities and items. Okay, so here you have it. This is the call for you to consider. We have in the YouTube link below, and this is not B-backs or comebacks. This is only for the bold. This is high risk trading, and not to be taken by inexperienced people. It's best to be in a community where you understand. I've just shown you a SimpleFX, which you'll find in the link below, of how you might trade this, and also the value of extreme risk rewards. This is actually one of the most conservative risk rewards that we've got, 12.89. You can potentially even double that. I can show you ridiculous ones, but you want to allow a little bit of breathing room. A possible bit of volatility may occur, a little bit of a spike one way before running the other way, and a final effort to try hold the dollar down is possible, and you can just be stopped out if you're trying to be too greedy. This is an example on the SimpleFX of taking 7.5 units, which is essentially a trade value of 750,000 USDC. This sizing may not be appropriate for many people. It may be too small for some. It will probably be too big for many. 1 point essentially equals roughly $1. The price of entry could be in and around the peg level. I would look for 70.84s rather than 70.085s. Use limit orders generally. Limit orders are your friend. There's still some movement, although the volatility is now so low. You could have, of course, been in this trade a lot earlier. If you've been in our community, we've been discussing this in our community for an extended period. This is a key moment, but we are sharing a premium trade with you now, so hopefully you'll hit the like button right now and give it a share to someone. What would the gains be on getting out at the maximum, most aggressive target? Now, I would warn that you would probably want to take off at 13.1 in the highly unlikely and not to happen overnight event of making 14.89. Your return would be $672,631. Your downside would be 521. So let me just say that again, 521 downside for 672. It's pretty extreme. I took the most aggressive target. By the way, if that was 13.1, you'd still be knocking on the door of a very spectacular number. And your downside would still be roughly the same. There was quite a bit of juice left for that, so that you could have a bit of a pullback. So there was, as I've said already, by far not the harshest, tightest risk reward. That ticket is what's on SimpleFX in the link below. If you cared to take this trade, bear in mind there's lots of ways we can fail. The dollar has a bad non-farm, and this ascending structure sells off. You must have a stop loss. Make sure you're closed. Manage your losses to be small. For some, that's not small. For others, it is. That's for you to decide what percentage of your portfolio that is. It should be low. And you can find out more how our views around that vary. What else can I say? They could, if we have a non-farm payrolls where the dollar, the growth is seen very, very poorly, and employment is low, and there's more downward pressure on the dollar, the Hong Kong could run that ascending grind line on that triangle that we were showing you just before. That blue line over here, this dark blue line could be run, or let me redraw it a little better. The pink line could be run to the downside, and then you could get some temporary respite. Remember, what we're trying to do is exceedingly hard. We are looking to call the event of a 40-year peg fail to within months, possibly weeks, maybe even days. So the non-farm payroll, Join us for our live trading day on Friday for the number coming in. You can spend just $197 and have 3 hours of me, 1.5 hours on traditional markets, short break, and another hour and a half on the crypto markets in terms of where we are today. And yes, there was a great crypto trade that I was bringing up to the community as well that was associated with my update this morning on this Hong Kong dollar. Okay, there is a link at themarketsniper.com below, and you can book a call, talk to traders like us. This is building wealth in reset times. We are saying many people are sleeping on one of the biggest potential events that can be coming. The beginning of a very clear and obvious Asian FX crisis. And we are warning that this is potentially brewing, and we are saying to you that we trust in the charts, and this is squeezing up, and every point you see this pubic hair being trimmed up top here is intervention expending dollars, precious dollars, that the HKMA holds, and that is being burnt down in an environment where flight capital will be leaving their equity market. In a moment when flight capital will be leaving their equity market. That equity market, again, let's show you that. Selling off in an environment where you have many Chinese investors and Western investors that may feel they would prefer to have more security. A beautiful inverted, learn about inverted structures with an additional fractal along the basing ascending grind line that are giving us targets in the 16,000 level. You are now trading 19.5. You could have been short above 25, and we expect this to go down, and it'll actually go down below what you are seeing here to the 16K level. So I'll put that on, and you can get an idea of the targets on that draw. Around 16.4 to the downside. You will potentially, given 2 interim targets run, we are the only method that actually gives interim targeting, by the way, get a possible rally, which could return your move to the green line, maybe a little bit in the funnel, but I wouldn't necessarily expect so. A bit of a move up before the major capitulation phase that would come for the run down to the 17.4. The open gaps are covered with momentum. This is stage 3 of the 5 stages of a breakout. Content you will learn about in our theory that is beautifully recorded for you in our community area. And this is the hardest sell point, and this could be the point when the most money is exiting Hong Kong and exiting both the equity markets and exiting Hong Kong dollars. If you wish to leave your risk exposure in a certain place, you not only sell the equities, you sell the currency, and you repatriate those funds elsewhere. This could lead to this period here, in this part of the capitulation, could be the point at which the peg fails or is restated by the government itself. Okay, I'm Francis Hunt. I'm the Market Sniper. I look at traditional macro charts to help my community build wealth in reset times and to protect it. If you want to speak to us about your needs, book a call at themarketsniper.com. Let's see where this happens. This is the trade nobody's talking about. Peg failures are an absolute widow maker. They're the most hardest things to call. I've done it twice on the Euro Swiss franc. And here you will have possible other opportunity. Within months, possibly weeks, maybe even days, I expect this peg to fall. It would be a fool's errand to spend all your dollars protecting something in an environment where capital is being extracted out of a very exposed equity market and flight capital is leaving. Bye for now. Thanks for watching. Thanks for sharing.